In a previous video, I asked this question: is it crazy to invest 200,000 into the palm oil sector? With this downturn, it looks like yes, because it has showed that you need to have industry knowledge with your investments. If not, you can't anticipate things correctly. But also no, because when we make investment choices, we are always doing so with incomplete information. And there's always going to be new changes that comes out along the way. It's more or less how we adapt. So in this journey, I've picked up 5 more important investment lessons regarding commodity sector, and I think they would eventually help me become more profitable. Today, I'd like to share them with you, and let's roll in the intro video. Hi guys, welcome back. Without further ado, let's dive on to the first point, which is this. Commodities are fungible, much more than I thought they were. What does fungible actually mean? I learned this term investing into crypto assets, and fungible simply means interchangeable. You know, when it comes to oil, for example, you can use oil, you can use coal, you can use natural gas. All these are all energy sources, but of course, for industries, they've customized the production to a particular energy source and it's not so easy to change. But what I came to realize is for agriculture, especially for consumption, they are a lot more fungible. You know, when Indonesia had this ban on palm oil, biggest customer India simply just moved on. Just to give you some background to things. Who actually buys palm oil? Unilever, for example, buy palm oil and they are based in Europe. They use palm oil to manufacture some of their cosmetics. But if you see in terms of total consumption of palm oil, the number one is India, followed by EU and China. All three account to 50% of world exports. Now, just now I mentioned that when Indonesia banned palm oil, India, its biggest customer, simply moved on. Palm oil imports in May, when the ban actually took place, dipped by 33%. So what exactly did India buy? Surely they have to continuously eat and cook, correct? They actually relied a bit more on soybean.
Annual duty-free import of 20 lakh metric tons of crude soybean and sunflower oil for 2 financial years.
I'll touch on it in a while, but let's move on to the second point, which is this. When commodity exports are banned, they generally hurt prices in the near term. Now, when it comes to long term, it's pretty easy. Supply and demand. If you have under-invested into mining and production and farming, naturally the long-term supply is a problem. And that's where prices are pressured to increase on a year-to-year basis. However, on a short-term basis, when a country bans its exports, they are actually indirectly hurting prices. Let's look at the list of countries with bans on their food exports. You see on this list that many of them are developing countries, and the list of commodities includes soybean from Argentina, palm oil from Indonesia, as well as wheat from Russia. Previously, when I heard the news that Indonesia banned palm oil exports, I was thinking that long-term supply dynamics would just run the entire equation. But that's actually not correct. Prices did not stay strong. The reason is because when Indonesia couldn't export, they saw a glut building up in palm oil. And just now I mentioned, India, its biggest consumer, moved on to an alternative, which means the glut in Indonesia built up quickly and there were no takers. When I checked around for reports, I saw stories of farmers letting their palm oil fruit rot simply because it didn't make sense economically to go and harvest. And in my further research, I came to know about this guy, Dorat Mistry. He is an expert in the vegetable oil industry, but as of this moment, he's an extreme bear on this sector. For the right reasons or not, we don't know. But what I'm using his point of view is to balance away my optimism to see things on a more critical basis. I suggest if you are a palm oil investor to also read what he has to say on the bearish thesis. Now, you know, just now I mentioned about understanding the industry. Many times we think we understand Google's ad business and that big tech is a safe place to invest. But when push comes to shove, maybe we'll soon realize that we do not really understand the business dynamics that well. But back to agricultural stock. How it works is like this. Imagine it as a tap, which means an export country like Indonesia flows its supply to India, China and EU. And in this pipe, if there are certain bottlenecks, you see that there will be a build-up. It's kind of like a dam. And when there's a build-up, there becomes a glut, which is what Indonesia is facing right now. Whether it's 8 million tons or 10 million tons, no one knows for sure. And when this glut happens in the domestic market, farmers and industry players over there are cutting prices aggressively to move out their stock because these stock have a shelf life. You can also imagine going to NTUC FairPrice or Cold Storage and pick on the discounted item that's going to expire today. Thankfully, Indonesia has lifted the ban, so hopefully this dam has been removed and water will start to flow again. The oversupply in the Indonesia domestic market would soon clear out and hopefully palm oil prices would normalize. With that, let's move on to point number 3, which is commodities impact one another. This point has certain similarities to it being fungible, but what I'm trying to get at is when a supply of one commodity is in trouble, it tends to benefit an alternative, because just now what we learned is that when India couldn't get palm oil supply, they actually relied on soybean oil for a while. And that is why if you check soybean prices, you realize that they stayed relatively strong, correct? They are in the green line over here. You compare that to palm oil, which is the blue line, you realize that it could be because of demand that has kept prices strong relative to palm oil and other kinds of oils. But having said that, it could also be argued now that palm oil is relatively cheap as compared to soybean. And what I've came to learn is that when prices of softer oil such as soybean oil is not more than $100 more expensive than palm oil, people actually prefer it because it's healthier. But if the price difference becomes too big, that's where they rather take the unhealthy version, which is palm oil. This could also mean that the fair value of palm oil is somewhere higher, especially if this glut starts to erase. Palm oil prices will naturally close in on the soybean prices, but that also does not equate to it necessarily going up. It could also mean that soybean prices would have to decline at this point of time. This point on commodities impacting one another is very important because this teaches that if something were to happen in South America, where Brazil and Argentina are big producers of soybean, naturally the dynamics will start to favor palm oil in some point of future. And it's a key tip that I'll keep on hand that hopefully you can take away from this discussion also. So speaking to here, if you have benefited, smash on like button because it's taken on team hours to prepare this presentation for you. And as always, if you have questions on commodities, leave them in the comment sections. I'll try to pick them up and help you get answers for them. With that, let's move on to point number 4, which is each commodity has its own unique dynamics. Palm oil, they're dependent on Malaysia and Indonesia because they account for more than 85% of total world's productions. So if it's politically challenging in these two countries, do expect supply to be a problem. What about soybean? Brazil is the biggest producer of it, and there are a few other South American countries in the top 5 list. So if something were to happen in South America, do expect soybean oil supply to have certain issues. What about for copper? Copper is used for everything in terms of industrialization. And many have said that they are one of the best indicators for economic activity, which also means when copper price declines, it suggests that a recession is coming. What about for oil, the king of energy? Realize that it's controlled by OPEC, as we know, and the biggest producer is Saudi Arabia, followed by Russia, US, and Canada. But oil in a big sense is not dependent on any particular country, which in my opinion reduces the country-specific risk. And in case you would like to trade on oil, you can actually buy US oil majors or an ETF on it, and you can actually buy them via the Weibo platform. Weibo is the proud sponsor for today, and if you are new to opening an account with them, there are free stocks that you can qualify for. I'm a user of the platform. If you're keen, screenshot this, scan the QR code, or look for links below to do a sign up today. Let's move on to point number 5, which is a pretty important one also. When commodities become scarce, developing countries are the ones that suffer the most. As we know right now, Ukraine ports have a lot of wheat, and there seems to be some negotiation that is completed to allow wheat exports, but again, that is a very iffy situation. Whether that eventually comes to fruition, nobody knows for sure. But what that story has taught me is that when commodities are in short supply, developed countries who have money, such as Germany, France, Italy, UK, or even in Singapore, we typically only face a price problem. Simply because we bid up the prices, we still get the quantities we need. But the developing countries are the ones that are unable to match the prices and see supply to them totally evaporate. That is why there's famine happening in Egypt and in many parts of Africa, simply because commodity prices are too expensive for them already. The same goes for oil. If oil prices reach $150, like what I mentioned could happen, I came to realize that the developed world would just cut back a little, but it's always business as usual. The developing world, on the other hand, they get into complete shutdown. Their industries get wiped out. Their economies cannot function. And that is seen right now in Sri Lanka. I have a previous video that shared on their plight. I hope to invite you there also to know a bit more on macroeconomics. Maybe that gives you a bit more insights to how things actually work. And if you'd like to find a bit more in terms of recession risk on commodities, check out this other video also. And hopefully this whole discussion has shed more light on how to interpret the commodities market to profit on it when opportunities arise. With that, I'll sign off from this tutorial. As always, smash the like button if you haven't done so. See you in the next one. Goodbye.